Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to.
Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes, and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing.
Welcome back to the deep dive. Today we're peering deep into the engine room of the Indian capital market.
We really are.
We're looking at that essential, often invisible infrastructure that processes trillions of rupees in transfers every single day.
The depository sector.
Exactly. It's like the foundational plumbing that makes sure every single stock trade, every mutual fund purchase actually ends up where it's supposed to.
Without it, the whole system just, well, it wouldn't work.
So let's just unpack that for a second. The source material describes this sector as a systemic utility, where this process, digital dematerialization, is the only legal way to transfer a security.
The only way. If you want to trade anything in India, you have to go through this system. The whole market basically functions as this regulated digital toll booth.
And that's really the core of our mission today, isn't it?
That's absolutely it. We're looking at the competitive landscape in this, very high margin, very asset light industry.
Which is dominated by just two companies.
Two entities. Central Depository Services Limited, CDSL, and National Securities Depository Limited, NSDL. Our goal here is to really understand how they're set up to monetize this tidal wave of growth in Indian domestic savings.
Right. To get that, we have to understand the ecosystem first. The whole thing is built around what they call market infrastructure institutions, or MIIs.
Which are very tightly regulated by SEBI.
So you have the two depositories, CDSL and NSDL, and then these critical middlemen, the DPs, or depository participants.
And those are your big banks, your discount brokerage firms, the ones who actually talk to investors.
And that network, that's the real moat here, isn't it?
It's a huge moat. The penetration is just astounding. Look, CDSL alone works with 574 DPs.
Wow.
Which means it covers something like 98% of the country's PIN codes.
So, total coverage. And that really shows the power of the business model. It's asset light, but
very heavily weighted towards specific operating costs.
Okay, so where does the money actually go?
Well, the cost structure is highly concentrated. The primary expense, a massive 45% of their total operating costs, is technology and IT.
45%. So they're really tech companies at their core.
They are essentially secure data processing companies. After tech, the next biggest chunk is employee benefits, at around 29%, not what you'd call a traditional financial institution.
And because they are these legal gatekeepers, the systemic utility, the profitability is just astronomical.
It really is. What's fascinating here is the margin profile.
Right.
You're looking at elite, standalone EBITDA margins that are consistently running between 60 and 65%.
60 to 65%. That's almost unheard of.
It is. Outside of, maybe a monopoly software company. But there's a really crucial caveat in the source material here.
Okay.
While the core depository business is incredibly profitable, the consolidated margins for the parent companies can get diluted.
How so?
By their non-core subsidiaries, particularly the, often zero-margin payments bank operations that a lot of these big financial players run. And that difference is going to be critical when we compare the two giants later on.
Got it. Okay, so let's move from that stable foundation to what's coming next. What are the big opportunities, the tailwinds pushing this sector forward?
Well, the number one driver, and this is probably the biggest story in Indian finance right now.
The financialization of savings.
Exactly. We are seeing this monumental secular shift of Indian household money away from things like gold and real estate.
It's the traditional physical asset.
Right. And into financial instruments, primarily equities.
And the numbers on this are just staggering.
They really are. Indian equity assets held in the system. They just exploded from about 12 lakh crore in 2020.
So roughly 145 billion US dollars.
Yeah, about that. To over 61 lakh crore by 2024.
Over $735 billion. That's a five-fold increase.
In just 4 years. And this isn't just the economy growing, it's a behavioral shift. It's more people using systematic investment plans, digital account opening, making it easier.
Yeah.
That's the tide lifting both of these boats.
And on top of that, there are regulatory tailwinds, too.
Big ones. Specifically what they call the unlisted company mandates.
Rule 9A and 9B.
Right. This rule makes it mandatory for all unlisted private companies to dematerialize their shares.
So this is growth that isn't even dependent on the stock market being hot.
Exactly. It's a guaranteed new recurring revenue pipeline for dematerialization. It ensures growth even if the market itself kind of goes sideways for a bit.
But as you said, the regulatory environment is a bit of a double-edged sword. It creates these mandates, but it also imposes limits. What are the big headwinds threatening these incredible margins?
So the most obvious one is regulatory intervention on fees. SEBI sees them as utilities, so it has put price caps on some of their fee structures. That's a direct hit to revenue.
Okay, that makes sense.
But I think the more insidious threat, the one that's creeping up on the margins, is the increasing demand for operational resilience.
Right, like the mandatory shift to T+0 settlement cycles.
Yes, getting trades to settle on the same day they're executed. That's a huge operational burden. It's not just about being fast, it's about eliminating latency and guaranteeing zero failures under massive, massive volume.
And that forces them into what the report calls infrastructure hardening. That sounds expensive. What does it actually mean?
It means cost inflation, plain and simple. It means huge mandatory tech spends on redundancy, on advanced cybersecurity, on disaster recovery systems, all to handle instantaneous matching.
So it's a structural cost increase.
It's a structural cost increase that directly threatens margin compression. Even for a company like CDSL with those elite 60+% margins. This risk, the danger of a technical glitch under these new high-frequency mandates, is now a core operational risk.
And we should probably just briefly touch on market cyclicality. I mean, their performance is obviously tied to retail participation.
Of course. When retail investors get quiet, transaction volumes fall. And for the more retail-focused player, you also have a concentration risk, a heavy reliance on a few big discount brokers to drive all that volume.
Which brings us perfectly to the competitor analysis. And I love the analogy the source material uses here. It says the sector is like a dual-lane digital highway.
It's a perfect analogy. It captures their fundamental difference in strategy.
So break that down for us.
Okay, so you have CDSL. They manage the lane with, as the analogy says, millions of individual motorcycles.
Retail investors.
The retail investors. They collect tiny little tolls from a massive and growing volume of users. NSDL, on the other hand, manages the other lane, the lane with the heavy-duty freight trucks.
So institutional investors, foreign portfolio investors, high net worth individuals.
Exactly. The volume of trucks is lower, but each one is carrying immense value.
Let's dig into that qualitatively. CDSL is the retail volume leader, no question.
Undisputed. Their moat is that deep, wide reach. We mentioned the 574 DPs that results in a colossal 15.3 dual-year crore or 153 million active accounts. Their whole game is about democratizing access and just maximizing the sheer number of users.
NSDL is a totally different beast. They are the institutional value leader.
Completely. They have far fewer accounts, but their dominance in the value of those accounts is absolute. They hold an overwhelming 86.81% market share in custody value.
86%.
Yeah. Their assets under custody, or AUC, is 464.16 lakh crore. Their moat is being the trusted partner for that massive institutional and foreign money coming into India. They are the digital toll bridge for global capital.
Okay, so that's the qualitative side. Now let's get to the numbers, the quantitative metrics, because this is where the two models really, really diverge.
They do. And the discrepancy in profitability is pretty shocking at first glance.
I'll say.
So CDSL's last 12 months, their LTM EBITDA margin is a super robust 59%.
59, okay.
NSDL's LTM EBITDA margin, and this is a consolidated number across all their businesses, is just 23.95%.
Wait, 24%. That's a 35-point spread.
It's a huge difference.
That feels unsustainable. I mean, how is that even possible when they're performing the same core function? Is NSDL just that much less efficient? Or is it all down to that payments bank you mentioned?
That's the key question,
Yeah.
right? And the report is pretty clear that the majority of that gap comes from the consolidation factor.
From the payments bank subsidiary, NPBL.
Exactly. That business is designed to run near zero margin, so when you roll it up into the consolidated financials, it just drags the whole average down significantly.
I see. So if you could strip that out, NSDL's core business would look a lot healthier.
Far healthier. Probably still a little below CDSL's just due to different cost structures,
Yeah.
but much closer. But, I mean, in terms of capturing that recent retail boom, CDSL has been the clear winner. Their one-year revenue growth was 33.23%.
And NSDL's.
A much more moderate 11.97%. The volume play is just generating far more immediate growth right now.
Okay, so we've got the volume growth engine in CDSL and the high-value institutional fortress in NSDL. Let's stress test them. What does this mean for them going forward? The report lays out 4 scenarios.
Let's run through them. First, the best-case scenario for everyone. a massive retail trading boom.
In that world, CDSL is the clear winner.
No question. They hold 79.5% of the retail market share. They're plugged into all the discount brokers that feed that boom. With their high operating leverage, all that extra volume just flows straight to the bottom line.
Okay, scenario 2. Instead of retail, we see a huge inflow of FPI or institutional money.
Now the tables are turned. NSDL becomes the primary beneficiary.
Because of that 86.81% custody market share?
Exactly. Any multi-billion-dollar institutional trade has to go through their system. This is where their high-value moat really shines. CDSL gets a piece, but it's a much smaller one for them.
All right, now for the risk scenario. SEBI comes in with strict fee caps, a major headwind for both. But who gets hurt more?
You'd think both equally, but there's a nuance. CDSL probably faces higher margin pressure.
Why?
Because its revenue is built on all those small, volume-based transaction fees from retail investors. Those are the easiest targets for regulatory caps. NSDL, however, might be a bit more resilient.
Because its revenue is anchored to the big institutional clients and HNIs.
Right, and those fees are generally less sensitive to caps. Plus, that payments bank, while it hurts margins, it also provides a sort of zero-margin buffer. It makes the core business a smaller part of the regulatory picture.
Interesting. Okay, final scenario. The long-term tailwind, the unlisted DMAT mandate. Who's better positioned to capture all these new unlisted companies coming online?
So both will benefit, obviously, but the data suggests NSDL is actually better positioned right now. Yeah. In Q4 of fiscal year 25, CDSL brought in about 3,500 unlisted companies. But NSDL holds a commanding 73% market share in unlisted company registrations overall.
73%, so they're already the default choice.
They seem to be, which sets them up perfectly to capture future revenue streams, especially if we see a boom in SME listings down the line.
So to sum it all up, the Indian depository market is really this fascinating study in segment concentration.
It is. You have CDSL winning the high-growth, high-volume retail battle, showing that incredible operating leverage. And then you have NSDL, which has secured that high-value institutional custody moat, making it the strategic partner for the big global and domestic money.
And when we wrap all this up, the final word, the core risk for both of these companies is that their profitability is completely tied to their status as a systemic utility.
That status is what gives them the high margins, but it also makes them a perpetual target for regulatory intervention, whether it's through price caps or, and I think this is more critical, mandated spending.
Which brings us to a final provocative thought for you, the listener, to sort of mull over.
Right. Ask yourself this. If these mandatory spends on tech resilience, all that infrastructure hardening for cybersecurity and T+0 compliance, if those costs continue to climb under SEBI's mandates, will CDSL's high standalone 60-65% EBITDA margin prove to be structurally sustainable? Or will that necessary structural operating cost inflation eventually compress the competitive advantage of both players? Will it push their margins down towards a lower, more standardized floor, the kind of margin you'd expect from any other regulated utility? What is the true long-term floor for margins in this business?
Something to think about as this digital highway just keeps getting faster and faster. Thanks for diving deep with us.
Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself.
See you next. Welcome to Analyst's Estimate,